Welcome to Echo Trade. This is Jeff Roth, and today we're here with Degas Wright from Decatur Capital Management, coming to us from Decatur, Georgia. And today we're going to talk about their DCM International Dividend portfolio offered within Echo Trade. So Degas, really excited to have you here. Thanks for taking some time.
Jeff, it's great to be here with you.
So yeah, let's dive into the portfolio and a quick background on Degas. So really interesting background. He was a West Point grad, a U.S. Army captain, I think about 30 years or so experience of investment management at this point. And you've probably seen him regularly on CNBC Halftime Money Report, at least a couple times a week. But so we're thankful to have him and his expertise on the platform. So Degas, let's dive into the portfolio. So the DCM International Dividend Fund. Let's start off kind of relatively high level. Just give me, kind of the overview of what, at least the kind of the overarching thesis is or the overall objective of the portfolio.
Yes, Jeff, the overall objective of the portfolio is growth and income. The international market actually rewards investors with dividends to a larger degree than the U.S. equity markets. In fact, the average dividend yield for the all-country world ex-U.S. is approximately 3% compared to the dividend yield of 1.5% for the S&P 500.
Wow. Yeah, so I was literally going to ask, what's kind of the importance of that global exposure and the focus of having this the international dividend side, but it's really on just the greater yields that you're getting from the international equities.
Exactly.
Yeah. So talk about then what you guys are doing and how you would look at that, how you look at risk. Everybody's always concerned about that. Are we taking on any more risk with the international market, or what are you guys doing to actually kind of mitigate that risk then?
Oh, Jeff, great question. Let's first define what risk is.
Yeah.
For most of our clients, they look at risk as the significant loss of capital. And so one of the things that we avoid is taking that significant risk of capital. And what happens with that is that if you go with a unsystematic risk that's not tied to the market, you could get into the areas of significant loss of capital. We avoid that by using such things as the exposure to countries, exposure to economic sector, also making sure that we're limiting our exposure to one individual stock. And so that's how we avoid the significant loss of capital. The next thing we want to do is, let's look at what's low risk. Low risk in this environment is perhaps like a corporate bond or a treasury bond type investment or portfolio, and we invest in bonds for our clients. And so that will be low risk because the risk there is interest rate risk, reinvestment risk. And as long as we hold bonds to maturity, there's really very little risk of capital. So what we're managing in the ADR international strategy is what we refer to as medium risk. And we're able to, once again, control that by looking at our country exposure, our economic sector exposure, and individual stock exposure. Also, we're looking at the downside of a particular stock by looking at a price floor relative to the market for each holding.
Got it. So a price floor relative to the market. So are you looking on a technical basis in terms of you have a floor on where you're going to allow that individual holding to fall to?
Exactly. So, and once again, it's tied to what's happening in the marketplace, and we look at that on a relative basis.
Yeah. So you're not saying, hey, you don't have a strike point or a stop loss necessarily. It's a moving target depending on how price and the market is reacting at any given moment.
Exactly.
Got it. And so what's kind of the investment process? I mean, actually, let me back it up. I want to talk about you talked a lot about, kind of some of the things you're doing to manage risk in terms of, the different countries and sectors. So so that's part of the diversification. You're looking to have country diversification, multiple, names, and as well as the sectors. Are you guys, kind of agnostic from sectors and just trying to have broader diversification across industries? Or are you looking at certain sectors that you like in any given moment while still maintaining, a diversified sector basis?
Well, Jeff, we're probably doing more of the latter because what we look at is around the country exposure and economic sector. You mentioned economic sector. So what we would do is have a range around each of the economic sectors based on the outlook for that particular economic sector. And that range could be approximately 400 basis points or 4% plus or minus the exposure in the underlying benchmark. And so that's the way we really try to manage that risk.
Gotcha. And then on the individual company basis, you guys aren't investing in ETFs or anything. This is all individual companies, correct?
Exactly. Well, that goes back to the use of the American Depository Receipts, ADRs.
Yep.
The reason why we selected ADRs is that this provides an exposure to foreign companies that an individual investor usually does not have access to. And this allows them to now invest in the actual foreign company. And this also benefits the foreign company because they get to have additional American investors invested in their company.
Yeah, exactly. So talk about that then, and the investment process. Are you guys screening, these different companies with some quantitative factors? Are you guys looking, from a sector side and then going down from there, or is it just individual companies that, and you're screening them based off of certain, technical and fundamental factors?
Oh, Jeff, what we do is that we look at several different factors within a company. So we're doing a bottom-up analysis, and that bottom-up analysis will include profitability. We were looking for companies in the top decile or top quartile for profitability within their economic sector. We also look at what we refer to as valuation, and we're also looking at that as it relates to economic sector. The one that we think is really unique is that we look at what's called, or what we refer to as expectations.
Yeah.
And the expectation is driven off of the regional drivers. What we found in the international markets is that there's different regional drivers. What I mean by that is that if you look at developed markets, and the developed markets are going to be like the UK, Europe, Japan, Asia Pacific. Each one of those various regions may have a different driver. They may have more analysts following a particular company. Also, if you look at the emerging markets, we follow companies in South America, Africa and the Middle East, Eastern Europe, and Asia, which includes India and China. So each one of these regions may have different drivers, and that's what we pick up in our expectations factor group. And so then once we have this model, we have a score per stock, and then we validate that through going through analyst reports and also looking at market sentiment for each company in our portfolio.
Yeah. And about how many names you typically hold at any given time?
Yeah. So the ADR International holds about 35 stocks.
And so you're looking at that. That's kind of where you're looking at that. That's a proper amount of diversification to have in the portfolio.
It is, because that gives us ability to have exposure to those regions that I talked about in a way that identifying the companies within regions that are going to be performing the best.
Yeah. And so talk a little bit about, you mentioned, this is a true international. You have some European exposure, some Asian exposure, but you also have some of those emerging markets as well. So how do you look at that, and what's the importance of having exposure there?
Well, Jeff, it's very important to have this diversification now, because if we look at the global markets, this is a very exciting time to have exposure to global markets, because what's happening, the demographics, the growth of the middle class in a lot of these emerging countries. Also, there's the growth of labor within these particular markets. And I'm going to just use India, for instance, which is an emerging market. It's one of the largest democracies in the world. And in the last few years, it's had GDP growth, gross domestic product growth, of over 7%. So this gives a great opportunity for both the growth in that domestic market, and also it lends itself to that labor market, that skilled labor market, that could benefit other markets that may not have the same labor pool as India does.
No, that's really interesting. I guess to wrap it up, can you kind of tell me what your thought process is on how this portfolio or this strategy might fit into a broader portfolio, where you might have, kind of a core US, equity portfolio. And then, like you said, maybe some fixed income in there. How would you see this, fitting into a broader portfolio?
The way this fits in is that it gives you obviously greater diversification. Let's just look at the country of Brazil, for instance. Brazil's inflation rate right now is 3.2%. And also, it's actually, the inflation rate is coming down much faster than it is in the United States.
Yeah.
And the fact that now you have exposure to Brazil is doing really well. The return on Brazil is about 20%. Well, it's similar to the US. So you can see how there could be opportunities overseas to give you the same type of growth than you get here in the United States.
Yeah, no, it's fantastic. And like I said, we're thrilled to have you on the platform, and investors can take a deeper look at the DCM International Dividend portfolio on Echo Trade. Degas, really appreciate you being here. Thanks for taking some time.
Thank you.